When you think about exposure to major trends or consistent growth, chances are infrastructure isn't front of mind, but perhaps it should be. In today's episode of The Pitch, we'll explore all things global listed infrastructure with Resolution Capital's Sarah Lau. Sarah, welcome.
Hi.
So to begin with, why should investors be thinking about using listed infrastructure in their portfolios?
The global listed infrastructure asset class is a defensive growth asset class, and it's really well suited to growing wealth over the long term via compounding. These are hard assets which are critical to the economy, and they provide essential services. So what this means is that they have monopolistic characteristics, and it means that the cash flows that they provide are sustainable, and also they will capture over the long run some mega trends such as digitization, decarbonisation and mobility, and provide growth above inflation for investors over the long run.
What are some of the misconceptions that you hear about infrastructure, and how do you counter these?
So there's two key misconceptions in infrastructure. Firstly, that it's a boring, low growth, interest rate sensitive asset class. It's not boring. And from our portfolio, we can see over the next 3 years, we're expecting earnings growth of 7%, and we think that this is going to accelerate as well. It's less interest rate sensitive than most people would think, because there is a high amount of inflation pass through from these assets. 87% of a portfolio is hedged to inflation. A second misconception is that listed infrastructure is inferior to unlisted infrastructure. To be clear, there's a very broad range of unlisted infrastructure, so there's very different risk categories amongst funds, but in an aggregate benchmark basis, listed and unlisted have actually provided very similar returns since 2001, 2002. They've both provided 11% returns on a total return basis per annum over the same period. And the quality of the assets in listed infrastructure are very high. In particular, there is less competitive and commodity exposure in terms of revenues in the listed space versus the unlisted space.
Why should investors be broadening their exposures globally rather than just relying on Australian names like Transurban?
So we think that the Australian opportunity set is very high quality, but at the same time, it's very small. Transurban is a company that is very high quality, but we look globally for the best ideas. So the name that we prefer is Ferrovial. It's listed in Spain, but the assets are predominantly in North America. It owns the 407 toll road in Toronto, which is considered to be one of the highest quality toll road assets globally. It also owns managed lanes in the US, so a lot of them are in that Dallas-Fort Worth catchment. And like Transurban, it is a good inflation hedge. They're both on 23 times EV/EBITDA, but Ferrovial is growing at its earnings at double-digit rates, whereas Transurban, we forecast sort of 7% earnings growth over the next 3 years. Other sort of opportunities that we can access globally include, for instance, airports. Sydney Airport was taken private, and we can no longer access that. We can access Auckland Airport on the ASX, but for us, it's trading at 18 times EV/EBITDA, and we see European airports trading at roughly half of that multiple. So when we look globally, we can see a more diverse opportunity set that's really being driven by sector themes in terms of its long-term growth and really, really attractive opportunities.
How can investors think about incorporating exposure to listed infrastructure in their portfolios?
So global listed infrastructure offers diversification benefits when combined with other asset classes in a portfolio. We tend to look at it as part of a real assets allocation, which includes property. And these are really complementary asset classes, both offering inflation protection in high quality hard assets. The risk for global listed infrastructure really sits between bonds and equity, and the returns offered by the sector have been very competitive when compared with general equities. So since 2001, global listed infrastructure has generated total returns of 10.3% per annum with a volatility of 13.5%. Over that same period, general equities has generated total returns of 8.5% with a volatility of 16%. So it does offer those diversification benefits. When we look at model retail portfolios, the general global listed infrastructure allocations typically between 3 and 5%. And we really think that the asset class offers a really good opportunity to compound and create wealth over the long run. Our portfolio is offering 7% earnings growth for the next 3 years, which we see as increasing over time. And importantly, these assets are positioned to provide above inflation growth for investors over the long run.
What tips do you have for investors looking at infrastructure?
So being selective is really important. The way that we see benchmarks is that they don't offer exposure to what we consider necessarily core infrastructure. We like to keep things pretty simple. We like quality assets with underappreciated optionality. We like solid balance sheets, and we like capable management with skin in the game. Ultimately, we think that valuations will follow earnings. Valuations, as we see it today, have actually reset for this higher interest rate environment. And over the long term, global listed infrastructure offers upside above inflation, tied to really long-term megatrends such as decarbonisation, mobility, and digitisation.
Thank you so much for sharing your insights today. If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.